Well, the market was higher, but major indices stumbled into the close, which I think perfectly reflects the market this week. The inability to gain traction is without a doubt frustrating. But what some people are missing is that there's also resolve as well. Now, today, investors opted for the safety of higher dividend-paying stocks, which lifted the utility and retail sectors. Although I will say the most compelling action actually came in industrials, led by Deere, W.W. Grainger, and FedEx, and of course, my favorite, everybody should be in United Rentals. Although many are sounding the alarm on the potential impact of a tariff skirmish on industrial names, I actually continue to believe that investors should be overweight this sector. Now, the period of indecision feels really strange. We know after 2017, which we saw all the major indices up almost every single day, right? And this is without a trace of volatility. While there is a sense of pause right now, I'm not sure I would call it indifference. Now, I have before, and I'll explain. According to the American Association of Individual Investors, there was a spike in bullishness this week as bearishness tumbled pretty hard. But most investors, in fact, overwhelmingly are neutral. Bullishness went to almost 37% up, over 10 percentage points. Bearishness down to 21%, down 7 percentage points. But almost 42% of investors call themselves neutral. Maybe, though, just maybe, this neutral thing doesn't mean indifference. Maybe it just means that investors are waiting and ready to pounce like a coiled spring. That's the message that I actually gleaned from a report out of Bank of America that says in the past week, the most money ever poured into stock funds. We're talking over $43 billion now. Most of it was earmarked for equities outside the United States, but it's still a ton of money nevertheless. I understand why investors are gearing up because the first quarter earnings report are going to come real soon, and I think they're going to be mind-boggling. Now, according to FactSet data, blended earnings for this quarter that we're in right now should come in at 17% growth. Now, going into last quarter, the estimate, the street had modeled for only 11% growth. And if these estimates are correct, it would be the biggest quarter of earnings growth since the first quarter of 2011. Before, of course, we can get to that, there's the Federal Reserve and that FOMC gathering that begins next week, where we know the Fed's going to hike rates. What Wall Street wants to hear is Jerome Powell take questions from professionals, not those nuts on Capitol Hill, that really made the Fed testimony a joke. I continue to say have patience and also be a coiled spring. You yourself, be ready, be a coiled spring, be ready to make some money.